A disappointing U.S. jobs report revealed only 57,000 jobs were created in June, triggering a surprising market rally. This unexpected performance has significant implications for investors and the future of Fed policy. Here's a comprehensive breakdown of today's pivotal economic event. Looking ahead, the job report's implications will be closely monitored by investors and economists alike. The latest data indicates a surprising dip in unemployment rates, which may signal a robust job market. This shift raises critical questions about the Federal Reserve's next steps regarding interest rates. In the coming weeks, analysts will seek clues from the Fed about whether they will delay or even cancel planned hikes. Historical context reveals that the Fed has been cautious about adjusting rates too aggressively to avoid stifling economic growth. The upcoming earnings season will also be pivotal, as there are growing concerns of an earnings bubble if profit forecasts continue to rise unsustainably. Companies may face pressure to meet inflated expectations, which could lead to disappointing results. Volatility within the tech sector may persist, particularly if AI companies encounter regulatory challenges or shifts in demand. Recent advancements in artificial intelligence have transformed the landscape, but scrutiny from regulators could hinder growth. Small-cap stocks may continue to perform well if rate expectations remain low, as these companies often benefit from a favorable borrowing environment. However, any rebound in hiring could alter this trajectory, leading to increased wage demands and potential inflationary pressures. As we navigate this evolving economic landscape, one question looms. How will the Fed respond to this surprising data, and what will it mean for the future of the U.S. economy? The central bank's decisions will be critical, as they will shape not only the stock market, but also consumer confidence and spending. Investors will be particularly focused on upcoming Fed meetings for signals on policy direction. The next few weeks will be crucial in determining the economic outlook as both markets and consumers brace for potential shifts in monetary policy. The current economic landscape has been shaped by a series of events leading up to this disappointing jobs report. Earlier in 2026, the U.S. economy showed signs of recovery with a rebound in hiring, spurred by robust consumer spending and easing pandemic-related restrictions. However, momentum slowed sharply in June, when rising energy prices contributed to inflation fears and speculation around potential rate hikes by the Federal Reserve. As gas and electricity costs surged, many households faced tighter budgets, prompting concerns about long-term consumer confidence. Recent drops in energy prices, however, have offered a glimmer of hope for easing those inflationary pressures, suggesting that inflation may stabilize in the coming months. Meanwhile, the tech sector had been experiencing growth, driven by advancements in artificial intelligence and increased demand for digital services. Yet, uncertainty loomed as chip makers and AI infrastructure companies faced significant challenges, including supply chain disruptions and geopolitical tensions impacting production. This combination of factors has culminated in the current scenario, where a weak jobs report has reshaped market expectations regarding Fed policy and economic stability. Analysts now predict that the Federal Reserve may adopt a more cautious approach to interest rate adjustments, prioritizing job growth over aggressive inflation-fighting measures. The labor market's health is crucial, as a slowdown in hiring could signal broader economic distress affecting consumer spending and business investment. Looking ahead, the interplay between energy prices and technological advancements will be critical in determining the economy's trajectory. If energy prices remain stable and the tech sector can navigate its challenges, there may be a path to recovery. Conversely, persistent inflation and job market weakness could prompt more drastic measures from policymakers. The coming months will be pivotal in shaping the economic outlook for 2026 and beyond. The recent weak jobs report has raised significant alarms across economic sectors, revealing that only 57,000 jobs were added in the last month. This figure starkly contrasts with the expectations of economists who anticipated a robust increase of around 200,000 jobs. The implications of such a report extend well beyond the immediate numbers. It suggests a potential shift in Federal Reserve policy. With inflation easing to a more manageable level, the Fed may find itself in a position to maintain interest rates at current levels or even contemplate future cuts to stimulate economic activity. This possibility has led to a market response characterized by a noticeable rotation into small-cap stocks and sectors such as financials and industrials, which typically thrive under lower interest rate expectations as borrowing costs decrease. However, the report casts a shadow on the resilience of the labor market. The sluggish job growth raises pressing concerns regarding consumer spending and corporate earnings. If hiring trends continue to falter, it could lead to a decrease in consumer confidence, which is vital for economic recovery. Households, already grappling with inflationary pressures and rising living costs, may tighten their budgets further, resulting in reduced spending. This contraction in consumer activity could adversely affect businesses, leading to a cycle of lower hiring and diminished economic growth. The significance of this jobs report cannot be overstated. For the average American worker, it translates into uncertainty regarding job security. A weak labor market often leads to heightened anxiety about layoffs and stagnation in wage growth. As consumers become more cautious, the ripple effects can be felt throughout the economy, influencing everything from retail sales to housing markets. Looking ahead, the Federal Reserve faces a delicate balancing act. Policymakers must weigh the need to stimulate economic growth against the risk of reigniting inflation. The outlook remains uncertain. If job growth does not pick up, the Fed may be compelled to act sooner rather than later. As businesses and consumers navigate this evolving landscape, they will closely monitor upcoming economic indicators, particularly the next jobs report, which will provide clearer insights into the labor market's health and the broader economy's trajectory. On July 4, 2026, major U.S. stock indexes experienced a notable rally following the release of the June jobs report. The report revealed that only 57,000 jobs were created, significantly lower than the anticipated 110,000. Despite this disappointing figure, the unemployment rate surprisingly dropped to 4.2%, suggesting some degree of labor market stability amid the slow hiring numbers. In addition, the report included ADP data confirming this trend, which reported just 98,000 new jobs, marking the smallest increase in 3 months. Initially, the markets reacted negatively, with futures indicating a downward trend before the market's opening. However, once trading commenced, there was a considerable surge in equities, indicating a shift in sentiment among investors. This lukewarm jobs data has sparked discussions about the current state of the economy. Analysts have pointed out that the labor market is showing signs of resilience, which could temper fears of a recession. The drop in the unemployment rate, despite the low job creation numbers, reflects a tightening labor market where fewer people are actively seeking employment. This scenario often leads to wage growth, which can stimulate consumer spending. Investors reacted to the jobs report by scaling back expectations for an imminent Federal Reserve rate hike, which has been a concern in recent months. The broad rally, particularly in small-cap stocks and sectors sensitive to interest rates, underscores the market's optimism about future growth prospects. The impact of this jobs report extends beyond immediate market reactions. It suggests that the Fed may take a more cautious approach to monetary policy, potentially delaying interest rate increases. This could provide a supportive environment for economic expansion, particularly for small businesses that thrive on lower borrowing costs. However, the subdued job creation raises questions about the sustainability of this growth. If hiring continues to lag, it may hinder long-term economic momentum. Looking ahead, market participants will closely monitor upcoming economic indicators to gauge the trajectory of growth. The focus will be on whether subsequent job reports can show improvement, as consistent job creation is essential for maintaining consumer confidence and spending. The next few months will be crucial in determining the overall health of the economy and the Federal Reserve's future policy decisions. What will the Federal Reserve's response be to this unexpected jobs data? Share your predictions in the comments below and subscribe for daily deep dives into crucial economic developments.